Flagship, you guys are super active. Every time I run into you and the team, you guys are always up to something.
I've got my corn here.
Oh, he's got the props. He's got the props. Prop number one.
I keep it with me just to not forget that the Midwest is there because they don't make much noise. They're just steady markets. This is a Koolaid pack from the 90s.
Drinking the Kool-Aid.
Drinking the Kool-Aids. Every time I say one of those markets, I'm going to drink the Kool-Aid.
You could show your battle scars, right?
Exactly. Investment committees dig scars.
Chicks dig scars, so does investment committee. Hey everyone, welcome to another episode of Deal Flow Friday. I'm your host, David Mogavam, and today we got Garrett Nondorf. Garrett is actually the Associate Director of Flagship Capital, and they're super active in the middle market, both debt and equity. Garrett's got a lot to offer. Garrett, you got your props, you're ready to go. We're going to talk shop. Garrett, how you doing?
Doing great. Doing great. Thanks for having me.
Good. After a few technical difficulties, we're here. So let's
made
get down. Yeah, let's get down to it. First off, I'm excited to have you. Your LinkedIn game is on fire. Your LinkedIn meme game is on fire. Every time I see you post, I'm cracking up. I'm a little disappointed that you don't have the mustache on this episode.
Yeah.
I was really excited to see it. It looks like you went full shave. I don't know who made you do it, or who made you take it off, but we need to make you grow it back.
Yeah. I think I've lost some of my power with it gone. My daughter, basically her whole life, I've had the mustache, and yesterday I took it off and she was just confused and just feeling all around. It's like,
Did you
"Dad,
record the reaction? Have you seen that trend going
Yes,
on where the
we did.
dads, you did it?
I tell you, dude, I really appreciate your optimism about that mustache. It was not a very strong one. I don't think, a lot of people haven't even noticed it's gone.
Yeah, because it's kind of blonde. It blends in.
Yeah. Thank you.
Like as
Yeah.
a Persian, as a dark Persian, when we grow a mustache, you see it. It's the first thing
Yeah.
you notice. And every man comments on it. Every woman doesn't want to talk to you. So it's really like a bro code with the mustache. So I had a little bit of a bro code with your mustache when I was seeing it on LinkedIn. So when you hopped on,
Love that.
I was a little disappointed, but you know what? We'll survive.
I'll try and make it up to you with some good content.
All right, good. Well, Flagship, you guys are super active. Every time I run into you and the team, you guys are always up to something. When I messaged you for you to hop on, you're like, well, we got a lot going on. 3 term sheets, you told me. 3 term sheets signed in the last 45 days.
Yeah.
A multi, a flex industrial, and an office. So break those down for me. What are you guys up to? What's your thesis right now? How are you being able to get deals capitalized?
Yeah. Appreciate it. So we do debt and equity. And so it gives us a little flexibility on how we can treat deals. The last few years, the equity product's been really popular. It's just LP equity. A lot of shops today, I think, you go to them and you say, hey, will you give me equity? And I'll say, yeah, we've got a great, mezz piece, pref piece. You're going to love it. It's, 8 and 8. That's not us. We like taking the upside today, especially in today's environment. So those 3 deals, 2 of them are equity. One of them is a debt deal. I'll just start with that one. That's a office deal here in Houston. It's out west, where a lot
The
of
office
energy
deal is
companies are.
a debt deal. Sorry, the office deal is a
Correct.
debt deal. Mhm.
Yeah. So bridge debt is what we do on the debt side. Kind of $5 to $15 million loans. This is kind of right down the fairway there, and a totally empty office building when we sign the term sheet. You you and I had talked kind of previously prior to this call, and you were just questioning that decision, the wisdom of that decision. I think for us, the basis was incredibly strong. You know, it's 2014 built product, so it's fairly new, and then the borrower is super strong balance sheet. So kind of put it all together, and Energy Corridor, in fact, is the hottest office market in the country. That I would not have said 2 years ago, or especially in 2020 when oil went negative, that story has totally changed. And so we're able to come in, feel good about our basis. They've got some leasing done. So that's that story.
And is
Uh,
Energy Corridor coming back from just AI and the demand for energy and the need for it, or is it something else?
yeah, good question. I don't know about AI coming into play. A lot of it is driven by demographics out west. So the population of Houston just kind of grows west. Uh, and then the really big piece is that they stopped building office out there for the most part. And so demand has sort of stayed, maybe a little bit down from 2020, but supply has corrected in a big way. And so you've got a lot less competition. Also, the floor plates on this product, it's a 4-story building, and floor plates are fairly large, 50, 60,000 square feet. That's a hard to find product out west right now. And so you have a lot of, oil and gas engineers, managers, executives who live out west. They don't want to drive all the way downtown. That's the attraction.
Nice. So that's on the debt side, an
Yep.
office deal, and you guys are probably, few and far in between, on
Yeah.
those providers. Let's talk about where you're putting equity, because kind of what you were saying in the beginning, you're long on the equity side, not just pref and credit, but you're going long on, putting common equity out. What are these two other deals that you guys got done or have term
Yeah.
sheets on?
Yeah. Well, getting them done. We don't want to upset the deal gods.
Yeah.
We so the Flex Industrial deal is in Columbus, Ohio. Columbus is a market you and I have talked about before. I mean, it's just popping. It's crazy what's happening there, population wise, job wise, and then Columbus didn't overbuild like a lot of really popular markets where jobs were coming, and so or not as much. So there's a good attraction there with demographic trends. This deal in particular is kind of sizable office component to it. It's a good looking deal, but if you saw it from the outside, you'd say it looks like an office building. There's bays on the backs. And so you can have a mix of tenants, which we like. I think it gives us flexibility and lease up. It's a 9 cap in place, which is incredible. Particularly, I think in Columbus, we just don't see a lot of 9 caps. We really don't see
Yeah.
anything, you
Yeah.
know? Anything kind of 7% and up, I feel good about. I don't know how much you guys look at commercial stuff. I know you guys are heavy on the multi side.
Yeah, we're strictly multi, but
Okay.
we're always keeping a pulse and an ear on kind of what other yields are out there. I mean, I can't speak for myself of what I've seen out there, but yeah, I mean, a 9 cap sounds pretty good, and they're probably borrowing at what, like 6, 7.
Yeah, 7 something, I think.
Hmm.
It's debt fund execution. And when you guys do go commercial, I want to be your first call. But yeah,
You got
anything
it.
kind of 7.5 and up, you can get positive leverage generally. And so positive leverage in today's environment, if I'm going to be a 5-year holder, I feel good about that. That's kind of like old school real estate. Can I make
Yeah.
cash day one? We kind of went away from that in 2021 and we said, hey, up and coming market, rent growth, yada, convince yourself to go do the deal. We've kind of gone back to, am I making money day one? Is there cash flow? So commercial, our bread and butter is multifamily, but commercial, we've seen these opportunities here and there, and equity in our space, the smaller mid-market space, has kind of gone away since 2022 when rates started coming up. So just taking advantage there, and that's a multi-tenant deal. I think it's a debt fund execution, 5 years, some IO, and positive leverage.
Nice. Yeah, and I mean, I've seen some of your posts. You guys have been super long in the Midwest. And it looks
Yeah.
like you guys have a lot of action there. It's actually interesting. We don't own in the Midwest. If you talk to Max, I think 50% of him is a little bit sour that he's kind of missed the wave. The other 50 is maybe um, a little bit of truth that maybe, if
Yeah.
everyone and their mother is talking about getting into the Midwest, maybe it's a little too late. What's your take on it? Do you think the ship has already sailed at this point? Do you think we're just getting started? Like, how are you feeling about the Midwest right now?
Yeah, I think Max is too cool for the Midwest, is his
Yeah.
problem.
Yeah.
Yeah, you Cali guys in particular, we love the Midwest. We all got my
Yes.
corn here.
Oh, he's got the props. He's
We
got the
we
props. Prop number one.
I keep it with me just to not forget that the Midwest is there because they don't make much noise.
Yeah.
They're just steady markets. We did last year 5 deals. um, Omaha, Nebraska, Springfield, Missouri, Lexington, Kentucky. You don't hear much about Lexington unless it's horse racing, and then
Hmm.
Omaha if it's college baseball. And other than that, you just really don't hear much about it. For that reason, they didn't build very much. They didn't build much supply, and so and you can still get a 6 cap. So for those reasons, I feel really safe going into the markets. They're still not building a lot for the most part. Kansas
And why is
City,
that? You think that's just natural topographical barriers? Is it municipality? How much of it is artificial versus how much of it is the rents not justifying the cost of
yeah,
construction?
yeah. I don't think there's a ton of artificial to it. I think it's a lot of natural. Those are just, it's not like a uh, Austin, Nashville, Phoenix, LA. Mom and dad, when I grow up, I'm going to move to the big city, LA or whatever. People, people want to say, I'm going to move to Omaha uh, when I make it big. No offense to Omaha. We own there. We love it.
Yeah.
But I think that's why I think it's just it builds naturally at kind of a 1% a year, 1.5%, 2% a year, steady growth. And that to us feels safe. Uh, I can bring in my other props here because this is along the line. So this is, if I can hold this up, a Kool-Aid pack from the 90s,
Drinking the Kool-Aid.
drinking the Kool-Aid. So there's 6 of these, 6. They all have these unique cap, if you remember that from your childhood.
Yeah.
Uh, so right now we're seeing 6 caps make a lot of sense. We're seeing things that were made in the 90s and newer make a lot of sense, like Kool-Aid. And then just because I'm mentioning Austin, Nashville, Phoenix, markets that got overheated and very popular, every time I say one of those markets, I'm going to drink the Kool-Aid.
Yeah.
So there's your Kool-Aid. Remember Kool-Aid, everybody.
I love it. Garrett, I mean, you guys are definitely long on the Midwest, like what we were talking about. I love the not only the yield you're getting, but you also get really good debt from an agency perspective
Mm,
because
yeah.
some of these 90s and newer, they're still within affordable, like rent affordability. Because in general, in the Midwest, people aren't stretching thin to live in an apartment. And
Right.
so what you get is these really strong communities that are still within the 80% AMI. You get mission financing. And so you end up getting pretty good leverage at really tight spreads over the treasury, and you're getting some strong cash flow. So it's not only just a 6 cap, but it's a 6 cap with mission driven financing for good quality product.
That's right. That's totally right. The 5 deals we did last year, all of them were agency, just like you said, and 3 of them in the Midwest. And one was a LIHTC deal where obviously mission driven is a huge component to that. We got a great rate on that, great terms. We're seeing you know, we have seen debt go from everything went agency in 23, 24. It felt like, if you couldn't get agency, deal just wasn't going to get done. This year, I've seen a lot more. I don't know if it was the political changes or what, but for a while, CMBS made a lot more sense. They came in on rates.
When you could
Uh,
just buy the rate down as much as possible to get the proceeds.
yes,
Let's do like an
yes,
8 point buy down to get like
you're
a
going to lock
2%
in for.
rate.
Yeah,
Yeah.
that's right. That's right. Yeah.
Yeah.
And people were doing that too. I thought that was
Yeah.
kind of interesting.
Yeah.
If you acted quickly, you could have done some of that. Its move to bridge actually has kind of become popular again. It's less of a bad word in my investment committee room. For a while there, we were all feeling the effects of the stuff we bought in 2020, 21
Mm-hmm.
with bridge.
Yep.
And so every asset management meeting that they're coming out of, they're like, "Oh man, that bridge deal we did." And then you go pitch a deal in an investment committee, and they're like, "You want us to do bridge?" So that we had to time. We had to run some time. And bridge, frankly, we've done this deal we closed in Des Moines 2 months ago. Was a 50 unit. There's another Midwest deal. Uh, that was a debt fund execution, debt fund out of Chicago. 5 years IO, fairly low rate. We like that, it's
Yeah. And
fixed.
sorry to cut you off. I mean, it's you said 5 years. I think people have learned also to like really have the runway this time,
Yes.
um, to have the runway. It sounds like you fixed it, maybe swapped it, or there's some sort of product where you're not as exposed to variable rates. It's better to just have something that's somewhat fixed so that you can just know what you're going to be paying. So I think bridge is coming back, but people have learned from their mistakes a bit.
Yes, and it won't be too long before they forget those lessons,
Yeah,
but
exactly,
that's America.
exactly. That's how it is. That's why we have cycles. So long on the Midwest, does this mean you're sour on the Sun Belt, or are you still what's your take on the Sun Belt right now?
SunBelt's still good. It's picked over a little bit. Um, just like 90s and newer, everybody is doing it.
Mhm.
Everybody's looking at the Sun Belt. It's got great demographic trends still. Some of those markets have seen change, but for the most part, still a really good place to invest. And so we are fortunate. We sit in a position where sponsors are out there digging in with sales brokers, sellers, trying to get somebody to shake loose on a good deal. We're the beneficiary of that as we sit here in our office in Houston and they say, "Hey, finally got somebody to capitulate. Will you look at my deal?" So they're doing the hard work. You guys are doing the hard work at Tryon,
Yep.
and we appreciate it for what it is. Uh, we're lucky that we can kind of wait for those things to come to us.
Yeah, it makes sense. And I think when you and I were talking, you were saying how the Austin, the Phoenixes, the Vegas, they're kind of coming to an interesting point for supply and demand. For those willing to take a bet, it could be interesting. So, are you feeling that those markets are a little bit of like a buy the dip moment, or could be potentially catching a falling knife where it could get a little worse? What's like your take on that right now?
Yeah, I was in a conversation with another GP of ours about Austin, Phoenix, Nashville, those kind of markets. I was saying, hey, if you look at the supply curve, it just drops off totally in 2026 on a lot of those markets. They saw a ton of supply. His counter was they saw a ton of supply and they're still absorbing that. And it's going to take time to absorb that. And so if you're looking at buying a deal today in one of those markets and you're thinking, I'm going to get rent growth in 26, you might be wrong
Yeah.
because it's going to take time for vacancy to go away, and historically it happens bottom up where Class C fills up, then Class B, then Class A, right? And so if you're a builder, you may be waiting a while, but my my counter to his was if I'm building today, and Flagship doesn't do any development equity, we're just acquisitions, but so this is a little bit outside my realm. But if I'm building today in one of those markets, I feel pretty good because I can look. I mean, it's not an opinion; it's a fact. You can look at what shovels are in the ground today, what projects are going to be delivering in 18, 24, 30 months, and I know what my competition is going to be and I can look and say, there isn't much competition. So I can be the new thing on the block and I can charge a premium for that. That's
Hmm.
that's my thesis. I think on older stuff in those markets, it's been super difficult because everybody bought the Class C. There was cap rate compression, especially in those markets. I mean, think of Phoenix in particular. You would know it well. Man, Class C was trading like Class B, trading almost like Class A. It was
Everything was the
crazy.
same. It was
It was
crazy.
crazy. And like Tucson was trading like Phoenix, you know? And it didn't make sense. And so those deals are stuck at prices that don't make sense to transact for the seller. They don't make sense, perhaps even for the lender to come in and say, hey, your term's up. And so everybody continues to kick the can. Here we are. Everybody survived till 25. It looks like we're gonna have to exist to 26 or something. But
I can't believe you went there and you said the saying. You said that in the mix to 26.
I know
But it's
I,
true. It's
I hate
true.
it.
And I think what you're seeing also right now is like on this Class C stuff, there's so much operational distress happening at these lower tier, lower quality deals. Where before it was cap stack distress, now it's fully operational. Some markets worse than others, but like the delinquency is starting to hit, especially if a deal has CARES Act. Like you're seeing a lot of late payers, you're seeing a lot of vacancy. I mean, a mid 90s vacancy is like almost mid 90s occupancy is almost non-existent in most markets. It's at least low 90s. 90, is kind of the norm. Low
Yeah,
90s if you're a really good operator. So everyone's feeling the cracks now. It's not catastrophic by any means, but it's starting to crack a little bit operationally.
I agree. That's what we're seeing too. Some of the SunBelt markets on the east side of the SunBelt, not as much the west stuff that was really hot is seeing that too. I mean, Atlanta, you saw a ton of bad debt, just like crazy bad debt, almost unique to the US.
Mm-hmm.
I think the way that they handled it on a local level made it tough. But they're getting through that. I think
Yeah.
there's opportunity there.
And there's now a stigma towards it, which,
That's
as
right.
you're saying, that's why there might be an opportunity. People have kind of been conditioned with, oh, Atlanta, the
Yeah,
delinquency so bad. It is what it is. We're out on Atlanta. Now you're seeing outsized cap rates for good product.
that's totally right. When I bring up an Atlanta deal in committee, you get that like a visceral response from the
100%.
like,
100%.
why are we talking about this? It's Atlanta. It's like, well, things are changing. So I think I put that in the bucket, same bucket as bridge. It's a bad word for a while, but it will, things will change.
Yeah. You guys doing anything in the West Coast? Like coastal California, Oregon, anything like that?
So we don't do anything in Cali, just a different political environment and
Mm-hmm.
just a different place, really. It's a beautiful place. Uh, and we do have stuff in Portland, Oregon, and then we've got something in Spokane, Washington.
Yeah.
So wouldn't call it exactly coastal, but we do have a few things out further west. And then kind of the next closest would be Las Vegas. And then we did some stuff in Phoenix that we sold in early 22, thankfully.
Yeah, well, Tryon, we cut our teeth in Pac-NorthWest and in Portland, and the political environment got a bit bad heading into
Yeah,
COVID. But what you're seeing today is a really good supply side story where there's just no supply being built. And contrary to what you're seeing in the Sun Belt, where it's just oversupplied right now and you're just getting through absorption, Portland has none of that. Is the demand the same? No. And that's why it doesn't get the headlines. It doesn't get, talked about in investment committee as excitingly. But what you're seeing is the supply side is really strong and robust, especially in the suburban neighborhoods, and people are paying rent. I would say our Portland deals and our California deals actually have the least amount of delinquency out of all the 8 states that we own in right now.
I think that's
So,
right for us too. Yep,
so there's something to be said there of maybe a somewhat out of favor kind of market due to some political headwinds that you're actually getting better fundamentals on what you're buying.
that's right. And Cali, as well as Oregon, Portland particularly, they have that artificial keeping supply low. They love to have 1,000 rounds of approvals for a multi-deal to get done, and
Yeah.
it ends up, 100 units goes to 8 units, and you don't really solve the problem.
Yeah,
Uh,
very true.
I think I saw Jay Parsons' post this morning about a affordable housing deal in Cali getting built for 1.2 million per unit.
Insane. Is that in LA?
I can't remember
I
where it
think that was the
was.
one in LA. It was like maybe like a Skid Row, affordable. I think it was something like that.
His line was like, you would expect that this has washer dryer, but no, it does.
Cable package. Yeah.
Yeah.
Nope.
Yeah.
Yeah, I mean LA is all over the headlines even right now with and I'm born and raised in LA, so it's
Yeah.
as a native, it's sad to see. Um does this make it an opportunity? It's just hard to quantify. As someone who raises equity, and we'll get into the equity raising right now because as you know, it's tough right now.
Very tough.
But it's even tougher when you're doing a business plan that you can't quantify the risk, right? And so
Yeah.
that's where LA makes it really tough.
Yeah. Because there's a big policy risk.
Yeah, exactly.
Yeah.
So, you guys have, you tell me what kind of what fund you're at this point and what you've raised, but I mean, you and I can both agree, and we'll be lying if we told each other that it's easy to raise that capital right now. It's very tough. Investment committee is tough. You guys are one of the active ones out of the rest from who we talk to. Talk to me about, I guess, how hard really is it? Who are you selecting, and what kind of deals are you kind of nitpicking to have conviction in to get through committee? And do you think this kind of dislocation in the market is creating an opportunity? And if so, what exactly?
It's a good question. Good questions. I'll try and address all of them if I can remember them all. Uh, I'll give you a good example of what activities like today. So for us, Flagship, we've got a $50 million fund today. We closed that fund, the initial closing, 10 months ago. And then we didn't do a deal till 2 months ago. That is not for lack of trying. We probably looked at, I don't know, hundreds of deals, certainly more than $1 billion in that time of requests, not total cap, but requests. And we're talking average request size, probably around somewhere in the 5 to 10 million mark. That's a lot of deals coming through
Yeah.
that you just say no to or
Hmm.
that don't work out for some reason. A lot of them are sellers. You've experienced this, I'm sure you guys have. Sellers, what can I get in the market? Don't like the number, and they pull it from them.
Yeah.
So frustrating. If I was a sponsor going through all the work of underwriting a deal, bidding, etc., oh my gosh, that would annoy me to no end. Thankfully, I'm not. You guys are out there doing the hard work. Uh, then you asked, and I guess we did 5 deals last year, and when I went to NMHC in January, I was a little bit downhearted about that. And I would say to people, "Well, we did 5 deals last year." And their jaw dropped because they're like, "That's so many," you
That's
know?
exactly. When you said you were disheartened, I'm like, that was before you talked to everyone. Yeah,
That's right.
exactly.
And now I feel like almost good about it. I would, if we could do 10 deals a year, that's kind of more ideal. But so that's I think a sense of volume. We've got 3 term sheets today. I'm hopeful all of those close, and we'll have done 4, kind of halfway through the year. It comes in waves. It's
Hmm.
great, and summer for real estate is a slow time just generally. But um, yeah, what is getting attention in investment committee? 6 caps, 90s and newer, and markets where you can point to, honestly, secondary and tertiary markets have gotten a lot of attention lately. So we did that deal in Des Moines. I'd call Des Moines a secondary market.
Right.
Um, top 200 markets probably, or an outlying exurb of, like a Kansas City that's got good demos, not much supply. You can kind of craft a story and then say, hey, and it's a six cap, so I'm positive leverage on a multi deal that was built in the last 30 years.
Yeah.
That feels just like a great story. There aren't a ton of those. So I'm not going to say that that is the market, but that's what gets attention for us right now.
I think it's hard to find high demo, secondary, tertiary that you have renters by necessity, right?
Yeah.
So sometimes you find these obscure markets, not obscure, but they're just, a little bit more out there, but everyone that's living, it's six-figure incomes and good schools and low supply. But then you also tell yourself like, do people want to rent here? I think the people that are here want to own a home here. This isn't a renter's
Yeah.
market. And so you run into that issue a bit, but at the same time, when you're looking at some of these rental apartments in the urban primary MSAs, you're getting hit hard with operational issues. And so sometimes when you're kind of out there, some of these secondary markets, you might not feel as much of the pain and the delinquency because they're renters by choice rather than necessity. So they're not stretched thin as much, theoretically.
Yeah. I think it's real. We have that conversation, the rent versus own, particularly when we're talking about a tertiary type market. You don't have a ton of people flooding into that market generally, although sometimes you can point and say to committee, this market's growing 10% a year. You know,
Yeah.
they grew by 50 people.
Yeah.
Yeah.
10% a year, one from 40. Yeah. From 45 to 50.
Yeah.
Yeah. So that makes sense. You can't get caught with your pants down there. But you know what? It's how you find good yield for good quality product right now. Um, I guess on the operational side, we talked about delinquency, but on the OpEx side, you're seeing that there was a lot of turbulence on specifically the two top expense items, taxes and insurance. You and I were talking about how that's kind of stabilizing. I know personally in our own portfolio, we've seen a 15% reduction on our Southeast master policy, which is huge. I mean, that's a game changer.
Really
And
big.
we're starting to see renewals come in lower on the insurance side. Like we're really just starting to see stabilization. I guess where are you seeing that with some of the other offers and deals that you're coming out with, and how are you underwriting, looking through that as you're developing your investment thesis?
Well, how much of your Southeast portfolio is Florida or Carolinas, coastal type?
Yeah, good question. I would say like a little less than half Florida, another
Okay, so a
third
really good chunk.
Georgia. Yeah, like probably another 20% Atlanta and another 20 Savannah. So like it's just a mix and then some Carolinas. So
Yeah. So I mean, a really good chunk of that is coastal, that where you'd be, insurance companies are thinking hurricanes and flood type risk. That's great. 15%, on a cap rate is a huge difference in
yeah,
value.
and exactly. And I think what you're seeing is part of that spike was the reinsurance markets kind of freezing up, right? And then now that there's a little bit more stability and these insurance carriers have increased their loss capacity,
Yeah.
and this is a new normal that these losses are kind of here to stay and they've already upsized their books for it. Now, when you have these catastrophic losses that are already baked in, it's like, okay, that was big, but it wasn't as big as what we underwrote. So people are starting to come back into the market. They're like, oh, we can make money here.
Yeah.
So I think you're starting to see that right now.
I think that's right. And they've probably reworked the deals, with their reinsurers to account for the increased risk. And so I'm sure they're paying more premiums to those guys. But it's such a huge market. you just know in America, someone's got to figure out a way to make money there.
Yeah.
And it seems like they have. I would say yes, on insurance, we're seeing stuff much calmer. Some things coming down. I wouldn't call it significantly, not really double digits, but you can underwrite for it now. Um, Taxes depends pretty heavily on locality, municipality, but here in Texas, we've seen them calm down as well. Yeah, Houston, you could underwrite 70% of purchase, in the good times, prior to 2020, and you'd be feeling good. Now you probably 90, 95. A lot of these deals are getting so reset that your basis, you can underwrite to 100 and you can get paying at 100 and you're still paying less than the guy was prior to you. So there's some wins to be had there, a silver lining, I would say. But yeah, OpEx wise, it's come in significantly from an acceleration standpoint. It's still up there, and sellers who haven't had to go underwrite new insurance or new taxes can't believe it when the broker tells them. So that makes it more difficult for somebody who's going to go try and get a seller off market to say, "Hey, I'd love to pay X for your deal." They're going to be like, "What are you underwriting for insurance?" And they're going to say, "Well, it's
Yeah.
1,400 a unit." And I say, "What are you talking about?" It's like, well, just go ask somebody.
Yeah, exactly. It's a little bit of a reality check. And I think that's why there's still a big dislocation on the off market channel because like there's still sellers that haven't seen the full OpEx reset that of what they're paying. So, and I think from a taxes perspective, there was so much uncertainty on kind of where these things were getting reassessed because there just weren't enough data points. And so
Right.
there was, some of these assessors were still using yesterday's pricing in order to get more tax revenue. And the appealing process was just getting tougher and tougher. Now you have a lot more data points from the past, 2-3 years of a down cycle. And so I
Yeah.
think that's, as you said, tailwinds moving forward on where we can kind of expect these things to shake out as a assessment of purchase price.
That's a very interesting point I hadn't considered in a market like Texas where it's a non-disclosure state.
Hmm.
Uh, the assessors are seeing way more data points, way more actual sale contract prices because they're saying, "Oh, your deal's worth 21 million," and you can go say, "Here's the contract, it's 19 and a half."
Yeah,
And so
exactly.
they're seeing a lot more of that. Which is
Yep.
just funny.
Yeah. Um, I guess, Garrett, one piece of advice for sponsors trying to get capital, maybe from Flagship, or maybe just out there, what's kind of some advice as you've been talking to investment committee and you've been allocating capital, whether it's any part of the stack, credit, pref, common, what's advice you could give to some other sponsors out there looking to capitalize their deals?
Yeah, I guess several things come to mind. If you did some deals in 21, 22, we all did. If you can point to performance around that, working with a lender, if it got to that point on a deal, and say to whomever the point of contact is at the fund you're trying to raise from, look at the asset management we've been able to do through the hard times. Then you've survived and you've proven yourself. You're now battle tested veteran. It should be easier for you to raise money. I know it probably doesn't feel that way, but here, in the investment committee room, we're saying, who are the people that made it through, who know how to buckle down and survive that OpEx increase, that rate increase, and got through it. If you can make it through the next, this period, however long this lasts, you're just going to be viewed differently than people who did.
You could show your battle scars, right?
Exactly.
I think,
Investment committees dig scars.
yeah, 100%. Exactly. Chick sticks scars, so does investment committee. I think what you're going to see coming out of this is a lot of sponsors who have scars to show, but it's all going to be a little bit relative, right? Some are getting wiped. Some are going out of business. Some have personal guarantees getting triggered,
Yeah.
while others did not only good work, but honorable work. They saw that, hey, this might have been a loss, but we moved the NOI this much. We moved operations this much. We have this to show. We learned from our mistakes. We made some new hires. We have a strong asset management team. And I think a lot of allocators, I hope, can at least see through that and see, hey, this is a group that has gone through multiple cycles, including this recent one. We can work with them.
That's right. The best thing you can say, maybe the best thing you can say on an investment committee call today, at least to my group, is we're going to go see the deal. Me personally, the sponsor, I'm going to be at the deal constantly, whatever that is, every week, every 2 weeks, whatever. I'm going to go live in one of the units, Those, that's a little extreme, but some people do it.
Some people do it.
I don't know how they have a family and do that, but they
Married to
do.
the game. Married to the
Married to
game.
the game,
Yeah.
yes. Because investment committee before that call just stepped out of an asset management meeting where they're probably upset at some sponsor who they bought 70s and 80s vintage stuff with in 21 who isn't, they feel like, paying enough attention. And so if you can massage that for them, it helps a ton getting a deal done. And I hope you'll also do it when the deal does get done.
Right.
Yeah.
Not just show it
Not
and
just say,
then, yeah, exactly. So, all right, Garrett. Well, do you have any more props to show before we hop off? Anything we missed?
there's one at my desk that I just couldn't bring myself to bring in here. It's a huge piece of turf from my garage. Secondary and tertiary markets, we're seeing a lot of investment committee loves them because you can get 6 cap plus in there. And I could not think of a prop for secondary and tertiary. And I was in my garage just like looking at the shelves and I was like, turf, tertiary?
Tertiary. I love it.
So that's there. Yeah. And it's going to stay there.
Awesome. Garrett, thanks again. Really appreciate it. This was a fun one. We got to run this back. Maybe we'll get JC on the next
Get
one too.
JC in here, dude. Get the
So
real action.
we'll make it happen. Garrett, really appreciate it. Looking forward to seeing you post your next meme on LinkedIn. Hopefully you grow the stash back. We're all rooting for it. And looking forward to keep showing you deals.
Thanks, buddy. Thanks for having me.
Awesome.